We're here today because every one of us has been watching the headlines unfold. In every major media outlet, from CNN, Fox News, the New York Times, and the Washington Post, to the BBC and obviously the People's Daily in Beijing, virtually every publication around the world's lead story is the rapid spread of the coronavirus. Right on its heels is the corresponding volatility on Wall Street, so our goal today is to provide an objective look at what really is and isn't happening with the virus, what is then resulting in the markets, what this could ultimately mean to you, and what 3 concrete actions you can be taking right now to help protect yourself financially. No matter where you turn right now, whether it's the TV, the radio, or scrolling through your phone, news of coronavirus rules the day. The latest death toll from the virus is now over 3,800 worldwide, with the vast majority in mainland China. But there have been over 108,000 global cases with outbreak in every continent except Antarctica. In Europe, the biggest outbreak so far is in Italy, and European nations are racing to control the contagion. As of March 9th, the Centers for Disease Control reported 423 confirmed cases of coronavirus within the United States, with a death toll of 19. To put that in perspective, in 2009, the H1N1 virus, which arose from Mexico, ended up in more than 200 countries and regions, resulting in over 60.8 million cases, 274,000 hospitalizations, and 12,469 deaths in the U.S. alone. Therefore, World Health Organization officials and U.S. experts urge everyone to keep things in perspective, but they also report that most of those infected will have next to no symptoms initially, making it hard to isolate patients who've contracted the illness. So at this particular point in time, those in the know are doing all they can to keep people from panicking. But as we all know, those in the know and those in the media are often 2 very different creatures. And as the media fans the flames of panic, so tends to follow the world. And as the world follows, so generally go the markets. Some of you have been sitting like this over the past few weeks, looking over your accounts or at the news headlines, watching what's been happening. On Monday, March 9th, 2020, the Dow Jones Industrial Average fell more than 2,100 points, dropping as much as 8.1%. The S&P 500 fell 7.7%, blowing through the first circuit breaker level that it tripped minutes after trading open for the day, marking its worst day since December 1st, 2008, when stocks fell by just over 9%. You know, sometimes we hear percentages in terms like S&P or the Dow Jones Industrial Average, and frankly, our minds kind of glaze over, right? Because truth be told, not all of us are mathematicians, and not everyone has a clue what the heck the S&P or Dow Jones even is. But let's make this incredibly simple for a second. Let's pretend for a moment that each of you here had put your retirement savings directly into the S&P 500 on Monday, March 9th. Well, I don't even know what the S&P is. How could I be invested in it? Well, the S&P 500, or the S&P as it's often called, is nothing more than an index, or a barometer, if you will, that measures the stock performance of 500 large companies listed on stock exchanges in the United States. Many people consider it to be one of the best representations of the U.S. stock market. So let's say that you had a $500,000 investment in the S&P 500 at 8 a.m. in the morning on Monday, March 9th. What if you needed to access your money at promptly 5 p.m. that afternoon? You'd have $462,000 remaining in your account following a 7.6% loss. In other words, $38,000 of your investment would have disappeared in the market that day alone. Now, many financial advisors might say something here like, yeah, but that's just the nature of the market, everyone. There are bound to be ups and downs, and we all just have to weather the storms every now and then. It's just the nature of investing. However, some retirees and soon-to-bes have a tough time hearing that they should just wait it out. Many folks have worked their whole lives, many well over 40 years, to get to this stage of life. This wonderful stage in which the finish line is finally within sight. Retirement and all the many dreams they've deferred just a few short yards away. And people like this, they have a hard time hearing, hey, never mind $38,000 of your hard-earned savings, money that likely took you years to accumulate. Never mind it just disappearing in a matter of hours. Just weather the storm. Frankly, there are a lot of things that men and women just like you hear from advisors all the time that you likely shouldn't. For instance, many of you have heard an advisor talk about something called the 4% rule. The 4% rule is a simple but pretty archaic rule of thumb that has to do with how much of your retirement savings you can safely take out or live off each year without presumably running out of money. For decades, advisors have been using this rule with their clients. Unfortunately, there's now all sorts of research showing that depending upon market performance and your specific lifespan and situation, you may not be able to pull anywhere close to 4% of your retirement savings out each year without running out of money. In other words, following this supposed rule is a little like betting the farm on the Farmer's Almanac. You can if you want to, but you may very well be betting the farm. But let's say you did. Let's say you've been following this 4% rule and you've got your $500,000 again invested in the market. At 4% per year, that means you'd be withdrawing $20,000 annually in income. If that had been the case on March 9th, 2020, you'd have just lost nearly 2 years' worth of retirement income in just 9 hours. 2 years of income that again may have taken you years to accumulate, gone in hours. And yet we're often told to just ride it out, and somehow everything will just turn out okay. So what do you do? If you could literally be losing money while sitting here watching this video, what should you be doing? The answer to that question, unlike someone who tells everyone the cookie-cutter solution is simply to ride things out, or run in the other direction and liquidate all your investments and run to cash, the real answer to that question is, it depends. Every single one of you watching this video has unique circumstances. No two of you are invested exactly the same. None of you have the exact same goals and visions of what retirement should look like. A few of you are inherently greater risk takers by nature and in pursuit of every dime the market might offer. And if so, well, the past decade's been a great run for you. Some of you have heard the term bull market. A bull market is simply a time in the market when stock prices are rising or expected to rise. And the longest running bull market in history celebrated its 10th anniversary on March 9th of last year. That's a decade of a rising market. So for those of you who are into grabbing every dime in the market you can get, it's been a great run. But there are also others of you watching this video right now who've grown more risk averse as you've aged. You realize that as you're getting closer to living off the money you've accumulated, you don't want as much to do with risking that pile of money. So you're actually 100% okay with taking a little less in return simply to help you minimize your risk. So regardless of whether you'd consider yourself a member of the first group, the daredevils in the market, or the second group, those happier pulling back the reins a little and knowing for a fact what they have to live on, there are 3 things everyone should be doing right now. The first thing at a time like this that's wise for everyone to have done is a simple risk exposure review. Regardless of where you'd consider yourself on the risk spectrum, every one of you would be wise to know what your actual risk exposure currently is. The vast majority of retirees and soon-to-bes consider themselves conservative, and yet when they have a risk exposure review done, they often find out that while their minds say they're conservative and couldn't really stomach much risk anymore, their portfolios often say otherwise, with a significant portion of their retirement assets exposed to market risk. Don't let this be you. A simple risk exposure review is all you need to find out exactly what percentage of your assets are at risk and therefore in jeopardy as markets decline. A risk exposure review is simply a review of your current assets to see how much risk they're exposed to. And what it does is show you how much of your retirement money you currently stand to lose should the markets drop or correct. But what that really means to you is that before something happens on Wall Street, you have the ability to see its impact, to play worst case scenario, if you will, and make adjustments now if you're not okay with that outcome. The second thing every one of you should be doing right now is sitting down to have a retirement income analysis done for you. Now, while a retirement income analysis may sound like something complicated from NASA, it's not. A retirement income analysis is nothing more than an analysis of the different sources of income you plan to use in retirement. This might include your 401k, maybe an IRA, maybe a few of you have a pension, maybe some other investments you plan to tap into, maybe even personal savings. And what this retirement income analysis does is analyze these different pockets of money to determine exactly which you should tap into first, exactly how long each one will last, and how you should leverage each one strategically to ensure you have paychecks that you create for yourself in retirement to last as long as you live. The single biggest concern of many retirees is simply, will we have enough? Will we outlive our money? But did you know you don't have to wonder about that? Did you know you can have that question mathematically and definitively answered for good? That's exactly what a retirement income analysis provides. Finally, every retiree and soon-to-be should be sitting down with someone right now to get a truly holistic financial plan together. If you're not sure if you already have one, here are 3 simple questions to ask yourself. Number 1, have I been resting completely easy these past few weeks as the markets have started dropping? Number 2, do I know exactly how I'll generate my own paychecks in retirement and exactly how long they'll last? And number 3, do I understand all of the products and investments I own and exactly how they work together for me? If your answer to any of those 3 questions was no, there's a good chance you have a portfolio rather than a plan. Having a portfolio is an awful lot like having a junk drawer in the kitchen. You know there are some really valuable things in there. You just don't know exactly what, and you don't know how to find things when you need them. People just like you, people who've been working with an advisor for 10 or 15 years, oftentimes they have a great portfolio, they just don't have a plan. And the time to know and understand your plan for retirement is now. We began a few minutes ago asking if the coronavirus could infect your retirement. The truth of the matter is it could. Indirectly, of course, but it could. And for some of you, it already may have. But you don't have to continue wondering about that. We've all been to the doctor before, some of us really concerned about a possible diagnosis. When it comes to your financial diagnosis, we all want to be told you have nothing to worry about, you're going to be just fine. The first step to hearing those words is simply having a complimentary 15-minute phone call with a member of our team. This call has absolutely no strings attached and is simply a way for you to determine if a complimentary risk exposure review, retirement income analysis, or holistic financial plan would benefit you. Don't let the coronavirus or recent volatility on Wall Street rob you of the reassurance you desire. Contact us today to get started and get the answers you deserve.